When it comes to retirement, do you want to have the same old plan everyone else has? Of course not. You're unique and have your own goals and dreams. Don't be treated like a number. This is your retirement. So it's time to think differently. And you're in luck because you found the Retire Your Way podcast with Dave Lopez, founder and managing member of ILG Financial. At ILG Financial, you won't find generic run-of-the-mill plans containing the same old cookie-cutter solutions. Dave and the ILG Financial team focus on building one retirement plan at a time using their Think Differently philosophy. And that means your own comprehensive plan with customized solutions built to achieve just one goal, yours. So put on your Think Differently hat and get ready to take back control of your retirement today and for all the tomorrows to come. ILG Financial's Retire Your Way podcast was created just for you, and it's starting right now. Coming to you from the ILG Financial Studios, this is Retire Your Way, the podcast that gives you the straight talk and honest insight you need to help you achieve your financial goals through smart investing and careful planning. My name is Jeff Shade, and I'm here to ask the questions, of course, but the words of wisdom and solid advice come from Dave Lopez, managing member and owner of ILG Financial. How you doing today, Dave?
Doing great. It's sure good to be back, and I'm looking forward to this show. It's going to be a real interesting episode.
Yeah, likewise too, Dave. Always have a lot of fun with you here in these podcasts because you got all the great information. We've got questions and you've got the answers there at ILG Financial. So first of all, Dave, I want to talk about something that I've been reading in the news a little bit. We all remember reading it, of course, the lost decade. Well, with the recent events surrounding coronavirus, political unrest, the election, we could be coming up on another lost decade. So first of all, Dave, define lost decade. What is it?
Yeah, you're starting to see more and more articles on the financial side talking about this as a potential outcome of the next 10 to 15 years. Let's talk a little bit about what they're talking about and what's happened. It got its coined phrase, the lost decade, was right after 2000. And just to give you an idea, the S&P 500 at the end of 1999 topped out at 1527. That was the amount of the index, 1527. Right. And then, of course, the dot-com bubble hit and it quickly lost roughly 50%. And then the government came in with some, I would argue, artificial stimulation. And remember, that was free mortgages for everybody.
Oh, yeah, I remember that.
Right? It created a recovery, an artificial recovery, I would argue. But it also energized the economy. So the market took back off and actually went up 100% and got back to even right around '08. And no sooner did it get back up to roughly 1527 and it crashed again because as a result of the free mortgages, we had a mortgage meltdown and we lost 50% again. And then the government stepped in a second time, kind of doubling down on their free money with, this time they called it quantitative easing, which was just, printing money and throwing it into the economy, which again artificially propped us up and caused a recovery, albeit artificial. But the result of that, Jeff, was from the end of 1999, where the S&P was 1527, to roughly mid-2012, the S&P hit 1527 again. So they're talking about 12 and a half years roughly, where the S&P ended exactly where it started. No gain at all. So if you had done a buy and hold in the S&P over that period, it would have been exactly where it started. The only gains you'd have had, if any, were any dividends that were split off, which are, relatively low. But once you subtract fees and taxes out of that, you're looking at 12 to 13 years of possibly no gains. And that's if you had the guts to ride out two 50% crashes without touching your money, which most people can't do. Now, that's the lost decade. What's interesting about that, Jeff, and this is the economic history buff in me, is people look at that like, wow, that was unusual. It really isn't that unusual. We can look back, if we look back historically, at how the markets have kind of performed. You see there's several instances historically where the market just doesn't go up at a steady clip. Give you a great example. It started back, there was an 18-year period, roughly around 1906, where the Dow Jones ended about 4% below where it started. 18 years of stagnation, just up and down, but no real growth in the value of the Dow Jones. Of course, after the Great Depression, which was roughly 1929, it took about 25 years just to get even. So if you had bought and hold after the market crashed in 29, it would have roughly taken you 25 years to get back even on the Dow Jones. Happened again in 1964 to 1982. You had roughly 18 years where the Dow Jones ended right where it started. 18 years of lost decade, that's a lost 18 years, almost a 20 years. And then, of course, this latest one that we just went over, 2000 to 2012. So it seems like it's more common than not. It's part of the normal economic cycle. And what's interesting is those lost decades, what they almost always follow is a prolonged period of a bull market, an up market. Well, we are right now at the tail end here of the longest up market in U.S. history. So the data would suggest that it's not bad luck that we have a lost decade, that it's probably the normal part of the economic cycle. So that's a lost decade.
Interesting, Dave. We know that history sometimes repeats itself. Dave, do you think this lost decade is a real threat?
Oh, yeah. Now, remember, nothing's set in stone, and I can't give you a better example of that than, the COVID virus coming in and surprising everybody. Now, that caused the market to tank roughly 37% in March. Now, the argument would have been we were overdue for a correction, so if it wasn't COVID, it would have been something else. The COVID was just the tinderbox, so to speak. But what surprised everybody when we look back is, wow, we've never had a recovery that quick. I mean, we're talking about months to get back even as opposed to years. Well, why did that surprise everyone? Well, there was a big unknown there, and the unknown was the government throwing $3 trillion into the economy to artificially prop us back up. Nobody betted on that because that's not something that's really ever been done before to that level, other than in the Great Depression era, they did something similar. So there are always unknowns, but we can look at the data and the facts and say, hey, listen, there's a likely scenario that this could happen because we are at the back end of a prolonged up period. And then you have other factors that are really generating the potential for what I would like to call a tepid return moving forward, specifically for folks that are holding on to this old model of 40 to 60% in stocks and the remaining 40 to 60% in bonds for a safer bucket. And the reason I say that is that, currently interest rates are at all-time lows. Well, the stock bond model that had worked in previous decades had worked because bonds were spitting out a reasonable rate of return. So most people, when they had their 40 or 50% in bonds, Jeff, they were expecting, 4 to 6% returns on that bucket with a lot less volatility than they would have seen on the stock side. Well, right now we are at all-time low interest rates. So if someone who's got 40, 50, or 60% on the bond side for a little stability are looking at, 0, 1, or 2% in interest rates, which just aren't cutting it. And now at the same time, if we're having a volatile stock market that could ending up 10 or 12 years later with little or no movement, wow, that is a recipe for disaster, especially for folks who are listening that are in or near retirement and are somehow hoping this old 40-60 stock model is going to guarantee them, 5 to 7% growth, and they're basing their retirement plan on that type growth. Could that happen? Yeah. But is there data to suggest they could also see a prolonged period of little to no gains on the stock side and very low returns on their bond side? Yeah, data suggests that's a very big possibility also.
All right, Dave, so you talked about the bond side there. Let's go back to the stock side a little bit. What kinds of issues are big companies facing these days that we want to be paying attention to?
Well, there's a couple that are headwinds, for lack of a better word, that could put pressure on earnings. And let me say why that's so important. Most folks, when they're buying stocks, or your prognosticators, when they're talking about the expectation that stocks will go up or down or a particular stock will increase, usually stocks are valued based on their estimates for future earnings. In fact, there's a ratio that most people use to decide if a stock is overpriced or not called the P/E, price to earnings ratio. Well, what that means is that your stock, the price divided by the potential earnings, will give you a ratio. And the historical norms are about 16 or 17 times earnings. Now, why is that important? Well, if projected earnings go down, then the projected, because of that price to earnings ratio, if earnings go down, then the estimated stock price is either too high or it's not going to go up because they're expecting less earnings. So what are some of the headwinds that are going to potentially give some challenges to earnings moving forward for companies? Well, one, which we'll be talking about in other podcasts, are this trend towards higher taxes, right? If we're believing that taxes are going up over time, that's going to hurt corporations, especially if we're talking about corporate taxes. Higher taxes mean less profit. Another one is there's a potential for increased operating costs as we move forward. Again, higher operating costs, lower profit. Lower profit means price to earnings ratio. To get it back to historical norms would mean a lower stock price. This is an interesting one too. Less efficient supply chains. And this is a result, this and the next point I want to talk about, deglobalization, is a result of this coronavirus effect on the economies. They had built out very efficient supply chains where these companies reached all over the world to get their parts and their service, getting stuff assembled in the way that was most efficient. And sometimes, Jeff, it was more efficient to have something built or assembled overseas and shipped back to the U.S. because the labor costs were so low. Well, because of COVID, companies are moving more towards deglobalization, which is, hey, we're going to bring everything back home. That way, if we have another COVID type situation, it's going to be easier to keep our supply chains working. Well, the result of that is the cost of goods is going to go up, right? The cost of manufacturing and assembling is going to go up, specifically in the U.S. because we have to pay our workers more. Well, higher costs. I'm sounding like a broken record here. Higher costs mean less earnings, means the price of stocks go down. So a lot of things are headwinds or obstacles moving forward for these companies that give us an idea that there could be a time of muted returns for stocks moving forward.
So Made in America is a good idea because, of course, we're putting Americans back to work. But by the same token, too, as you said, I mean, we had a lot of parts and things that were done overseas where labor is less expensive. And with COVID, not being able to take advantage of those opportunities anymore, costs could go up. And, of course, that's going to mean less profit for these companies. So it's sort of a catch-22 situation there. The stock market has been up. It has been down. It's really been quite volatile. But, these stock market highs, how can the market sometimes be at an all-time high considering all the things we've talked about?
Yeah, it is a conundrum, right, for many. Despite severe economic hit with the coronavirus pandemic, the U.S. is relatively, even as this recording, still at or near all-time highs and is completely recovered from the plunge that we saw in March. So it really begs the question, what's going on? Well, there's a couple things that you want to be aware of. One, the upward momentum is due to, I would suggest, a few things that you would want to say are major factors. The first is the Federal Reserve has been keeping interest rates at or near zero, all-time lows. Now, what that does is it does a few things as far as the stock prices. One, it means borrowing costs for companies remain very low. Companies love low borrowing costs, right? So if they can borrow cheap, they can invest in their company, they can do other things that cause their stock price to go up. Another advantage with respect to stock price of low interest rates is companies borrowing money very cheaply, but not reinvesting in the company and expanding. They use that money to buy their own stock. They're called stock buybacks, and it's not necessarily a good thing. And it's really one of the things was at a peak during the Great Depression, and for a time was kind of outlawed. Well, stock buybacks mean there's a huge buyback of a stock, which brings the price back up. So the price is going up, but it's not because the company's necessarily doing so well, and that could come back to bite our economy. So those two things can cause the prices to go up because of low interest rates. A third reason low interest rates can cause prices to go up in the stock market is you've got a lot of folks, and we see this firsthand, that have a portion of their assets that they specifically don't want at risk in the market. They want to put it somewhere safer, usually bonds or something like that, and get a reasonable rate of return. And by that, most folks are used to 4 to 5% in something that's less volatile than stocks. But by artificially holding these interest rates at all-time lows, you're forcing people who would rather not be in the stock market but need some rate of return to take more risk than they're willing to and go into the stock market. So that's more people in the market, means the prices go up. Now, again, that's very frightening, right? Because you have folks that really don't have the stomach for the volatility of the market that are in the market. And once the market starts to turn, that people that aren't used to risking their life savings in the market are going to panic and pull out. which could cause the markets to correct very drastically.
We're talking about the lost decade with Dave Lopez of ILG Financial. Of course, ILG stands for Income, Legacy, and Growth. And it's quite obvious that Dave has done a lot of work in this area, understanding the market and understanding trends in order to help you get to and through retirement. And as the name of our show suggests, to retire your way. If you'd like a no-cost complimentary financial plan with Dave Lopez, maybe you don't have a plan and you want to get a look at where you are, where you could go. Once again, there is no cost for this for our loyal listeners to this podcast. Call 540-720-5656 for that plan, 540-720-5656. And if you're listening to this show and you think I've already got a plan, but I'm not really so sure that it's the best plan for me, you want a second set of eyes on that. Of course, Dave is happy to take a look at that plan for you and tell you what he thinks of that. And if he can do better, he'll tell you. But if he can't, he'll tell you that too. Once again, 540-720-5656. You can also take a look at the website at ilgfinancial.com and request your plan there. Dave, we're talking about the lost decade here, and you've really covered a lot of great points. Is there anything else that you can add to this?
Well, we were talking right before the break there about things that have really caused the market to be at or near all-time highs, even when other indicators of the economy seems to think that that maybe shouldn't be the case. We talked about interest rates being at all-time lows. That's a big driver for the market to go up. The other one that's a really great example of something that can push the market higher was after the market crashed in March, the government stepped in with a roughly $3 trillion fiscal stimulus package. Well, that is just flooding the economy with free money, right? So think about your household. If you're out of work and you don't know how to pay the rent and you can't cover your bills and you can't buy groceries, things look very bad, don't they, Jeff?
Absolutely. They couldn't be worse.
So as a household, you're in a recession or a depression and there's panic. But if your father-in-law just starts putting money into your bank account, right, even though you're still out of work, things operate as normal at home. As long as the income's still coming in, the artificial money going into your bank account has temporarily relieved any of the symptoms of your household recession or being out of work. Well, that's what happened in March when the economy tanked, right? We lost all these jobs. We're still at roughly 20 to 25 million people out of work. But you throw $3 trillion in the market in the form of free money and PPP loans to small businesses to keep them afloat, and $600 a week, which, roughly doing the math is close to $40,000 a year for folks that aren't working. Well, it's just like that example I gave with your father-in-law giving you money. There really are no ill effects as far as the consumers are concerned because their pocketbooks aren't affected. Now, that's only good until the stimulus stops. So where you see that is, right around election time when people are waiting for another stimulus check and it's not coming, that's when the market starts to get afraid because this only works as long as the father-in-law keeps giving you free money. And as soon as the government stops with these stimulus checks, we're going to have to face the reality that people are out of work, they're not getting money, they can't pay their rents, and then you're going to start to see the effects of what we see in every recession, which is a slowdown in the economy, people losing jobs, bankruptcies, defaults. It's a normal part of the economic cycle. I can't stress that enough. But you have to go through it to turn and start a new economic expansion cycle. So my takeaway for everybody with respect to that would be these are two examples, the fiscal stimulus and the historically low interest rates that are causing the stock prices to remain high. It's not the only thing, but those are two factors. The question you have to ask yourself when trying to make decisions in the market is, do you expect those things to continue long term? And those are two of the things that I would argue can't continue forever. So sooner or later, we're going to have to deal with this deficit and pulling out of this recession that's caused by all these folks out of work. And then I think you might see a correction in the market.
Well, Dave, we've had some stimulus here in the past, and it looks like we may have a little more here in the future. But as you said, that cannot go on forever and ever. And when that stimulus does stop, I think economies and the way businesses do business has changed forever. And, a lot of people have lost jobs. They may not get them back. They're going to have to reinvent themselves. So it's going to be a whole different economy. So, Dave, I know that you and I do not have a crystal ball. At least we don't have one that works. And some data here that I'm looking at suggests that the stock market may be in for a bit of a crash here. Do you think that that is a real possibility?
Absolutely a possibility. And of course, the other possibility is we continue to do fiscal stimulus, $3 trillion here, $3 trillion there, and just keep printing the money and delay that for 6 months or 12 months or a year or several years, right? So here's the big takeaway, Jeff, for the folks listening, is me specifically, but all of these financial pundits that you hear talking about the markets, nobody knows short term. I've said it before, and I want to say it again. I'm a big fan of Warren Buffett. Warren Buffett said, if you're not willing to put your money in the stock market and leave it untouched for 10 years minimum, you have no business being in the market for 10 minutes. So when you're looking at investing in the market, the takeaway would be we do not know short term what's going to happen, if the market's going to crash tomorrow or 6 months or 2 years from now. But historically, the market does go up and it does correct, and then it goes back up and it does correct. So know that when you invest in the market, that's part of it, and you need to only invest money that you're willing to leave long term and expect corrections. Now, the takeaway is, how do you decide what to put in the market, what not to put in the market? The way is you build out a comprehensive plan and you decide how much to put in the market and what parts of the market to invest in based on your risk tolerance and based on how you plan to use this money in the future. Are you going to need this money in a year, or are you not going to need this money for 20 years? Those things are going to decide how to invest, and that's what we do for our clients. So the big takeaway from all of this is we don't know what we don't know. There's no reason to go at it alone if this is not your expertise. If you're a certified financial planner, go at it alone. But if this isn't your expertise, get some help, have a coach, give us a call, let us build out a plan for you so you can take a look at some of these variables we're talking about on the phone, and we can get a realistic plan that'll give you a great chance of success regardless how the market performs over the next 10 to 20 years. That's my takeaway for this podcast.
Well, aside from volatility, Dave, I think one thing the stock market isn't short of these days are doomsday predictions. So if you're a little worried about these predictions, as Dave says, I think the best way to hedge against all this is to have a comprehensive financial plan. And of course, we're offering it again for our loyal listeners. No cost, no obligation. To get yours, call 540-720-5656. That's 540-720-5656. And of course, go to the website, ilgfinancial.com. There's a lot of great information there that'll tell you a little bit more about the company. And you can also email us from that website to get your comprehensive, no cost, no obligation financial plan. Once again, that is ilgfinancial.com. Dave, always a great time with these podcasts with you because you have so much great information. And I want to thank everybody for taking the time to join us on our show today. Of course, our podcasts can be found wherever great podcasts are heard. And if you missed previous shows, of course, they're all right there. And we invite people to join us again each week for a new podcast here on Retire Your Way. So we're out of time for this week. For Dave Lopez, I'm Jeff Shade. Thanks so much for listening. Have a great day. We'll talk to you again next time with another edition of Retire Your Way. The information provided is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. The views presented today are those of Dave Lopez and not necessarily represent the views of AlphaStar Capital Management, LLC. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Investment advisory services offered through AlphaStar Capital Management, LLC, an SEC-registered investment advisor. SEC registration does not constitute an endorsement of the firm by the Commission, nor does it indicate that the advisor has attained a particular level of skill or ability. AlphaStar and ILG Financial, LLC are independent entities.